The Carlyle Group. It's an asset management company that doesn't just invest in businesses, it transforms them. It's a global powerhouse that is a catalyst for innovation and value creation. With its proven track record of strategic investments, breadth and depth of expertise, the Carlyle Group is leading the future of private equity. My name is Maher, and I'm here today to tell you why Carlyle Group is a buy at $46 with an upside of 26%. Carlyle specializes in alternative asset management and operates across three main segments: private equity, global credit, and real assets. My investment thesis is based off three main principles, the first of which being that Carlyle Group is a high leverage business model. They are an active asset manager rather than passive, meaning that rather than waiting around for investment opportunities to pop up, they can go out and actively curate their own through their private equity arm. Second, the Carlyle Group has a wide competitive moat that I'll break down in detail shortly. And lastly, they are capitalizing on a first mover advantage regarding shifting demographics. More and more now are individuals getting the chance to leverage their own capital through private equity. This trend is seen with Carlyle through platforms such as iCapital and All Funds, which allow individuals to invest. Alongside of this, we are seeing the largest generation, baby boomers, and the wealthiest generation, Generation X, reaching retirement, the stage of their life which they are looking to preserve and grow their wealth in retirement, meaning there's now a large influx of individual investor capital that Carlyle has taken the initiative to pivot and capture, creating the perfect opportunity for Carlyle to grow. Now let's dive back into the advantageous competitive positioning I mentioned earlier. For Carlyle, this is marked by four things: high switching costs, economies of scale, brand equity, and a strong network effect. The high switching cost is due to long-term relationships with institutional clients with such large sums of capital that they are unlikely to replace their trusted capital managers. Investors may also have to liquidate some positions when switching asset managers, which can lead to unwanted tax burdens. Now, the advantage of economies for scale for Carlyle is slightly different than firms in other industries. And what it does for Carlyle is they have such a large amount of assets under management that they are able to achieve diversity in their investments while still having a significant amount of capital in each place. Now, the brand equity. Carlyle can leverage brand equity on both ends. On the investor side, Carlyle can attract and be trusted with large sums of capital as they are a reputable asset manager. On the business side, businesses are eager to work with and become one of Carlyle's portfolio companies due to, again, their reputation and network. So, about that network, the global reach and large footprint, Carlyle creates an extensive network effect, allowing them to source a multitude of exclusive deals. The network allows them to give smaller companies an opportunity to partner with larger firms in their network. The private equity industry has flourished over the past decade with a compound annual growth rate of around 13%. However, that was not without its ups and downs. During COVID, this rate dipped to around 8% but quickly rebounded to 12% in 2021 as firms adjusted and pivoted to resilient sectors like healthcare that flourished during the pandemic. Private equity has historically been dominated by the Western Hemisphere, and still is, but the Asian market is rapidly expanding. The market share between firms is distributed relatively equally compared to other industries, despite characteristics of an oligopolistic market like high barriers to entry. Something to note here is where Carlyle fits in within the industry and who its peers are. We can see that Carlyle is a top 5 firm sharing the space with firms like KKR, Apollo, and Blackstone. A standout feature about Carlyle's finances is their poor performance in 2023. This was due to operational headwinds and market volatility. However, if we look at 1, the recovery and positive momentum after 2023, and 2, the years besides 2023, we can see that the Carlyle Group has performed incredibly in terms of profitability metrics, and their ability to recover quickly signals a strong management and positive future for their valuation. Breaking down Carlyle's finances, starting with revenue, we can see management fees are the main driver of revenue, and they are the fees that Carlyle collects for simply having assets under management, regardless of their performance. These management fees add stability to the firm, something that Carlyle has lacked in the past, but with their assets under management projected to increase by $20 billion in 2025, investors can be optimistic about the future of the company. So, Carlyle will see growth due to increased assets under management, but where else? Carlyle has proved before that they can generate a large return on assets, but with the struggling year in 2023 and 2024 being used to recover, we have not seen a large return on assets in the past 2 years. This year, that is set to change. The Carlyle Group has positive momentum, increased stability, and I'm confident we will see return on assets grow this year. The Carlyle Group has great profitability in the past and showed an increase in earnings per share by over 250% last year from the year before. But a unique aspect I would like to note is Carlyle's use of AI to increase operational efficiency and boost profit. More on that later. My 2026 target price is $58 per share for Carlyle Group, which represents a 26% upside from the current share price. The two methods I used for valuation were a relative valuation model and a discounted cash flow model. For the valuation, I will walk through both models as well as cover some of the investment risks. To get a comparable average for the Carlyle Group, I used 4 different firms with similar characteristics as Carlyle revealed by the industry analysis. However, the Carlyle Group stands out from its peers with a low price-to-earnings ratio, so using the average is not the most accurate approach. For this reason, I applied a 32% discount to get my target price to earnings multiple of 20. Using the product of the projected third-year earnings per share and the target price to earnings multiple, I got an intrinsic value per share of $58.9, giving an upside of 27.8%. For the DCF analysis, you can see the results and key assumptions to the right. The intrinsic value per share coming from the quotient of the sum of the present values of cash flows and shares outstanding. Now, to discuss key assumptions. From my research, the growth rate for the Carlyle Group in the next 5 years is predicted to be 10%. The terminal growth rate, however, is very hard to predict due to the volatile nature of the company. For example, revenue grew by 83% in 2024 and decreased by 33% in 2023. Therefore, the best option is to use the industry average of 6.18%. However, taking into account the extreme volatile nature of the Carlyle Group, I went with a more conservative assumption of 5.7%. The average discount rate for the private equity industry is very high. It's around 8 to 12%. However, due to the previously mentioned uniquely diversified nature of the Carlyle Group, their discount rate is normally around 5.8 to 7.8 range, which is why I chose a 6.8% discount rate. Moving on to investment risks, starting with market volatility, the performance of Carlyle is dependent upon mainly 2 things: their management and performance fees from their assets under management, the latter of which is dependent upon the performance of the assets, primarily firms, and thus the market. For the illiquidity risk, the majority of Carlyle's assets under management are in private equity and alternative assets, both of which are illiquid, which can pose difficulties during periods of financial stress. And lastly, Carlyle often uses investor capital for private equity ventures to amplify returns. However, with that financing comes added risk for the Carlyle Group, especially in volatile markets. Carlyle itself performs well in terms of ESG considerations. According to the Upright Project, Carlyle has a net impact ratio of positive 18%, which means through their efforts and initiatives have had a positive sustainability impact. They are a net benefit. So let's break that down for each category. For the environmental impact, Carlyle has pursued projects like Cardinal Renewables. Through Carlyle's Sustainable Energy Fund, they have given $100 million to Cardinal Renewables and a partnership to offset greenhouse emissions. Eco Value Screen. Carlyle partnered with the Environmental Defense Fund to create a tool to identify operational changes that improve environmental performance. Additionally, Carlyle has been carbon neutral for all operations across 3 years. Now for the society aspect, Carlyle partnered up aiming to support social initiatives. One of these ventures was with Accelerated Learning Incorporated, working to develop a digital curriculum where traditional textbooks may not be available. Moving on to board representation, Carlyle set out to achieve a 30% diverse board by 2023. They blew past this goal, achieving 59% diverse board representation by 2022. And now for corporate governance. Carlyle has a corporate governance guidelines and training where they provide ESG training to their whole leadership team, in addition to working with their portfolio companies to improve governance structures. For environmental governance, Carlyle was one of the first and only private equity firms to publish climate-related financial disclosures, as they created a task force for this operation. The largest single entity shareholders are still individuals, the co-founders of the company, Daniel Danilo at 9.1%, William Conaway at 8.4%, and David Rubenstein at 8.2%. Yet as a cohort, there's a larger presence of institutional shareholders, with Vanguard, BlackRock, and Capital Research and Management all individually around 6%. For independents, the board is composed of both independent and non-independent members, which are the co-founders. The lead independent director is Lawton W. Fitt. To maintain a balance of power, the board of directors does not have direct oversight over the company. Instead, operates through a series of committees, providing a set of checks and balances within the governance. Regarding AI considerations, there are both direct and indirect effects as a result of the increase in prominence of AI. Directly, it has affected due diligence in global portfolio solutions. Carlyle uses AI in its global portfolio solutions to optimize its decision-making and evaluate trends more effectively, allowing for more strategic investments. The use of AI in daily tasks reduces operational costs, boosting net profit, driving up EPS, and resulting in a higher valuation. It also affects enhanced decision-making. With AI-enhanced decision-making, Carlyle Group can analyze larger amounts of data more effectively, resulting in more strategic investments. Now, indirectly, being regarded as the industry leader helps improve the general sentiment around Carlyle Group, which in turn enhances investor confidence and will lead to more investor capital for Carlyle Group to leverage in their portfolio. Thank you for listening.